This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk, and financial solutions.
Yeah. Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Emanuel, Datt, mate, thanks very much for coming back on Talk Your Book, fresh from holidays. I thought before we get into your stock pick of choice, if you could talk to us about Datt Capital and how you guys look to invest.
Yeah, sure. Thanks, Chris. So Datt Capital, we're a boutique Melbourne-based fund, and we're an absolute return fund that focuses on achieving double-digit returns every financial year. And we've been doing very successfully, and we've more than almost doubled our promise to our investors since inception, which is a great place to be.
And you managed to do the double digits last financial year, I believe, which is no mean feat. Is that correct?
Yeah, absolutely. So we achieved a positive financial return in the last financial year in the low teens. And since inception, we've done about 17% per annum.
That's awesome. And what stock did you want to talk about today?
So today I wanted to talk about Whitehaven Coal, which is an ASX-listed thermal coal player.
And maybe before we get into the nuts and bolts of Whitehaven, talk to us about the thermal coal market overall. Maybe illustrate just how strong it's been over the last 12 to 18 months for those that haven't been following it as closely.
Yeah, sure. So I think that probably the best place to start with is to sort of talk about the difference between thermal coal and met or coking coal. So effectively, met and coking coal is used primarily for steel production. Thermal coals are typically used for power generation. So a lot of investors get that confused or don't really understand what the difference is. And so effectively, Whitehaven, as I mentioned before, it's a thermal coal producer. It effectively its customers are primarily East Asian customers, so Japanese, Korean sort of power plants that rely on high quality thermal coals. Don't sell anything to China, which is a good place to be. And so I think that a really interesting dynamic that we've seen in the just over the last month or so has been typically steel making coals, coking coals have been priced a lot higher historically than thermal coal. But now we've seen over the last month that dynamic has changed. We're actually seeing met coals being priced significantly cheaper than thermal coals, which really tells you a lot about how the supply and demand mismatch sits at this point in time. And I'm actually seeing some met coals that may be able to be sold into thermal markets starting to rotate towards being sold as thermal coal rather than being badged as they are historically.
Which speaks to just the tightness in energy commodities at the minute. We've obviously seen it in oil, albeit coming off a little bit overnight. And, the whole of Europe and I guess the whole of the world wants to decrease their reliance on Russian gas. Given that nuclear power plants at the quickest take 10 years to build, Europe wants to get off Russian gas. And the solar and wind, whilst can produce power, can't produce the quantum of power or the reliability over 24 hours of a day that traditional power sources can. We're seeing Germany add thermal coal plants, China adding a lot of thermal coal plants. Is that sort of the logical step for the next 12 to 18 months while everyone really tries to decrease their reliance on Russian gas, that thermal coal plants will increase more so than perhaps was initially thought they would at this phase of their existence?
Yeah, absolutely. And, I'd probably say that the situation will persist for far longer than 12 months if Germany are going against their own previous ESG principles, as you mentioned, by restarting sort of previously mothballed thermal coal power plants, then I think that really tells you that the situation is probably going to persist for longer than we probably expect. And also, I guess the other point is that cheap Russian gas has been really the basis of the EU economy for quite a long period of time. So I think that even if peace was to suddenly break out, or some sort of peace accord to be brokered in Ukraine, between Ukraine and Russia, I don't necessarily think sanctions will be lifted in any sort of form for some period of time. But ultimately, I think the EU are clearly trying to move away from its past reliance on cheap Russian gas and move into other forms of energy. And nuclear is obviously one which I think is fairly obvious, but as you point out, it's going to take a long time to deliver these sort of alternative forms of power.
And there's a rule for commodity investors that you buy commodity stocks when they're high PEs and you sell them when they're low PEs, because it usually means they're about to mean revert as new supply comes on to squash the price. Is the dynamic in commodities like oil and thermal coal a little bit different, where they're not allowed to be owned by many institutions due to mandates or ESG conflictions, and certainly a lot of banks now are unable to finance projects? Do you think it sort of differs to that traditional rule about once you see a resource stock being on a low PE, that's probably time to think about selling it?
Yeah, absolutely. Well, I think, as you point out, I think that a lot of investors and professional investors at that, as you say, may be unable to invest in these sort of companies due to mandates, or fund mandates, I should say. And, I think someone did some analysis around, how funds window dress. So they might buy exposure to these companies at the start of the month and then sell prior to the month end, so it doesn't actually show up on their books when they report to their investors. So it's a bit of a cheeky way, but I think that truly does demonstrate how, if you're sort of investing in these commodity exposures that are being priced extremely cheaply, in many cases less than 1 times free cash flow at spot prices, I think that as an investor, you're probably missing out on something if you don't have some exposure to these sort of opportunities. And going to the point about, your point about, buying when P's at a cyclical high and selling when they're low. Sure, I think that may have worked in the past, but I think it really, you really have to be flexible and understand what the rationale behind, why this has worked perhaps in the past, but why I don't think it's necessarily going to work in the future. And just to give you an idea about sort of the moves in thermal coal in particular, in March 2020, we had thermal coal priced at $50 a ton, or thereabouts. This is in US dollars. And today we see it at close to $400 a ton at the front end. So for prices to move by that quantum and sustainably, stay above $300, I think it's been for the last 4 or 5 months. That really does tell you that there's one of the demand for these sort of commodity products, but 2, that there's just an abject lack of supply. And as you mentioned, I think a lot of it has been due to these ESG considerations, which make permitting of new mines very difficult. In Australia itself, the average length of time it takes to permit a new coal mine is in excess of 10 years in many cases. So it's not like it's a tap that can be suddenly turned on. But then again, there are permitted development assets, but these are reasonably difficult to finance, I'd say, in this sort of environment. And that's why we're seeing a lot of these coal players, they're actually not even bothering to push development along, because they're not assured of development financing, but also when these assets are delivered, if they've already got producing assets that are being priced at 1 times free cash flow, then what's the point in taking all that development risk, right, and cost risk? You'd rather just pass on your cash earnings through to shareholders, whether it be buybacks or through dividends or whichever way the company chooses to. I think from a capital allocation point of view, why would you invest in something that's going to be valued at such a extremely low multiple?
And I know no one's got a crystal ball, but when you sort of model out these companies, what input do you use for thermal coal going out for 2 to 3 years?
Well, you can use transparent sort of markers like the futures market is one obvious point to use prices for. But even I think the really attractive element of this thesis is that you could assume the commodity price has been cut in half. And given the extremely low valuations of these various thermal coal players, it really barely moves the needle. If they're trading at sort of 1 times free cash flow at current spot prices, if the commodity price itself is cut in half, they might be trading at 2 times free cash flow, which is incredibly cheap for any other sort of sector. So
it's like a nightclub multiple.
Yeah,
you don't really see a lot of listed companies with those sort of multiples, do you?
Exactly. And even at half the commodity price, I mean, at current prices, Whitehaven has a gross margin of, probably close to 80% or even over 80%, which is almost like a software company, gross margin. And it's just incredible that, even at even if the commodity price was cut in half, these would still be wildly profitable either way you look at it.
And so let's maybe dig into Whitehaven in specific. Whereabouts are their producing assets?
Yeah, sure. So Whitehaven have 3 main assets. These are all in New South Wales. So Maules Creek is sort of the flagship mine. Then you've got a couple of other smaller assets in Narrabri and Gunnedah. And I think that Whitehaven have a real advantage in being with the assets being located in New South Wales. You've probably seen, I think it was last week or the week before, Queensland actually enacted or increased royalties on existing coal mines. And I think that really sort of is detrimental to the industry as a whole, because as I was talking about, in terms of the swings in prices, in the commodity prices itself, these industries are and have been, historically very cyclical. But to get through the tough times, you have to be able to capitalize in the good times. But if the government's taking, a big chunk of that upside, then it really makes it a lot more difficult going forward.
It just speaks to a supply response that's going to be slower to come again. It's just another handbrake, if you like, isn't it, to allocators of capital looking to try and potentially fix the lack of supply in this area.
Yeah, absolutely. And I think that, New South Wales is probably a far more attractive jurisdiction than Queensland, just because of this royalty interest. But also, for companies that are operating in New South Wales, they've suddenly been given a huge competitive advantage. It's no secret that all commodity companies or commodity producing companies are experiencing labour shortages. So if you're a mine in New South Wales, you can effectively pay a lot more to your workers relative to a Queensland located mine or based mine. And, so effectively the Queensland government has just given a big free kick to the New South Wales producers. That's our opinion.
And talk me through the numbers. What PE multiple does it trade on? Maybe a little bit about their balance sheet and their capital management initiatives.
Yeah, sure. So Whitehaven, at this point, they are totally debt-free. Our estimate is that, in terms of pre-tax margins for this last quarter, we estimate that they've probably earned about $1.2 billion Aussie. This is pre-tax, of course. So, post-tax, you probably assume maybe 800 million And that's for one quarter, I should add. So you think
On a
about,
market cap of what?
of a market cap of about just over 4 bill. So, pretty more or less, 1 times pre-tax free cash flow it's trading at, or even slightly less. So I think that's just incredibly cheap. And I think one thing that is really pleasing to us is that the company have started to return cash aggressively, or value aggressively, back to shareholders. So they've just, they're at the tail end of a 10% buyback. So I think they bought back about 360 million odd shares on market. And they've actually just recently upsized that to 550 million. So they still have a fair bit of capacity left. And no doubt they'll probably start to buy back after they release their next lot of results in a couple of weeks. And I just think that that's still just such a small drop in the ocean, given how much cash they've probably generated this last quarter. So I wouldn't be surprised to see a lot more aggressive moves, in terms of maybe more aggressive off-market style buybacks or greater dividends going forward. And it makes it a really compelling opportunity for us, I think.
And you've been talking about this stock for a long time online at far cheaper levels.
Yeah.
Where do you feel like you are in the trade? Do you feel like you're 50% of the way through it? Do you feel like you're 80% through and you just got 20% of the cream to go? How are you sort of viewing it at this stage and what's been a highly successful trade for you?
Yeah, absolutely. So I think we started talking about this back in September, October last year. So it's been almost a year, but I think in that time, it's been almost, it's been a significant return, like well above 50 to 80%, I'd imagine. And I think that we are still, reasonably early, I'd say. I'd probably say that maybe, off the top of my head, I'd say we're maybe 1/3 of the way through the trade. And I think a lot of that comes down to the fact that, well, earnings have definitely exploded in that time frame, but we've seen the return in the stock itself has been in the 80% or slightly above, but earnings have exploded by hundreds of percents. So I think that ultimately fundamentals have to win out over time. And so effectively the next leg up, we think, will be in the PE or multiple expansion on these significant earnings. I think that ultimately, the market is perhaps telling us that, it's still undecided on whether, or on the sustainability of these earnings itself. But I think that each month that goes along, or each quarter that goes along, we're just going to get more and more evidence that, this situation in the market and for the company itself is perhaps going to go on for a lot longer than the market is perhaps giving the company credit for. So I think that, at current pricing, it's highly attractive still. We've been topping up at these prices, I must admit, because it's really just one of the most compelling situations that we've seen ever in our time in the markets. And we're more than prepared to put our money where our mouth is.
And other professional money managers that have to manage redemptions and think about monthly performance, when they do get a big winner, they might be inclined to shave some out, maybe more so than a private investor that is prepared to have lumpier returns. Mm-hmm. Where do you sort of fit in that context? If this runs, do you generally shave some out and use that to allocate elsewhere? Or with the type of capital you've got invested, are you able to take on that volatility a bit more and hold for a longer term position?
Yeah, look, we're prepared to hold for the longer term. Ultimately, we think that the stock could double from here and still look incredibly cheap. And we've seen various sectors and industries go through periods of time where they are sort of perceived as unfashionable. And I think that the coal sector is really just going through a similar sort of phase. But once a sector does come into fashion, that's when you see multiples increase materially. And I think, probably at that time you might think about taking off a bit of the position. But ultimately, as long as the companies keep returning capital to shareholders and taking care of us, not doing silly things, then that's what we want to see, and that's where we want to be invested ultimately. And I think that just the opportunity itself is just so compelling. I don't feel any impetus to sort of try and trade around the position too much. And I think it's just extraordinary.
Thank you, mate. Well, it's a very interesting one. I think that whole ESG dynamic where people are going to have to perhaps choose between or understand that climate change is important, as is food security in third world countries, as is people not freezing to death in Europe.
Yeah.
And probably they're going to have to negotiate perhaps a more balanced approach to that whole ESG dynamic going forward, because energy prices and food prices are just inextricably linked, and the potential coming food crisis looks like it's going to start in 3 or 4 months around the world is going to be pretty horrible. And if oil's closer to $200 rather than $80, it's going to be a lot worse for those people. So it's an interesting, complex time.
Yeah, absolutely. And also one other factor to consider is, we're seeing interest rate rises pretty aggressively across the board in all these Western economies. So, I'd rather have my money sort of parked in something that is, returning double digits to investors over a period of, say 12 months, rather than sitting in the bank. And just understanding that there probably is a real opportunity cost in not being invested in these sort of exposures. And ultimately, as you point out, I think that ESG has made these investments unpopular, but I think that's definitely going to change going forward.
Beauty. Thanks very much, Emanuel. Thanks for coming back on the show.
No worries. Cheers, Chris. Thanks for having us.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.